last week we discussed the later part of the session. We discussed about options with a reminder or revising what we discussed on option. Then we'll move into the remaining part of options. Especially we talk today we are going to talk about option premium. What are the factors that affect option premium? And then there's a very important relationship between call options and put options, which we call put call parity. We'll discuss at the end. We'll discuss that relationship as well. So just to remind, if you can remember, we discuss options. What is an option? Option, as we discussed last week, gives a right to the buyer. Gives a right to the buyer. This is a product where the buyer of the option gets a right. What is the right that buyer gets? That depends on the type of the option. Based on that, there are two types of options: call option and put options. The call option, the buyer gets the right to buy.
Excuse me, sir. The screen need to be converted. We are supposed to be in a reverse side.
Is it the same for others as well?
Yes.
Yes, sir.
So we were discussing about option. Option gives a right to the buyer. If it is a call option, the right is to buy the underlying. And if it is put option, that gives a right to sell the underlying. These are the basics: call option and put option. Call option gives the right to buy. Put option gives the right to sell to the buyer of the option. When you can exercise your right as a buyer, that depends on, again, whether it's a American option or a European option. So in an American option, the buyer can exercise his right on or before expiry. In the European option, it's only on the expiry date, not before. In American option, there's a time period. During that period, anytime the buyer can exercise his right. It can be a call option or a put option, but his right, buyer's right, can be exercised at any time during the lifetime of the option. But in the European option, the buyer can exercise his right only on the expiry date. So these are the basic of options. Then we discuss if this is the spot price on that, and this is the strike price. When do you exercise your right if you are a buyer of a call option? If you are a buyer of a call option, you exercise your right in this area. That means when the spot price is above the strike price, because you have the right to buy whatever the underlying at the strike price, but the current market price is higher than the strike price. Therefore, you have a profit. So whenever spot price is greater than strike price, then the buyer of a call option will exercise his right. But on the other hand, for a put option, it's the other way around. Put option will be exercised only if the market price of the underlying is less than the strike price. Then the buyer of a put option will exercise his right. What does it mean? When the market price is somewhere here, lower than the strike price, the buyer of the put option can sell that underlying at the strike price, and this difference will be a gain or the payoff to the buyer of the option. This part is the payoff. Whatever the difference between strike price and the spot price is the payoff for the option buyer if it is exercised. So based on that, then we drew a diagram profit diagram. This is the spot price. Strike price. X means strike price. For a call option, what is the profit diagram? Before that, I just want to remind premium. What is premium? That is the payment the buyer make to get this right. If you are a buyer of a call option or a put option, to buy the option, you have to pay a price. That price we call premium. At the time of you entering into the transaction, the buyer pays this premium to the seller. This right won't come for free. There's a cost for this right. To buy that right, you have to pay the premium. You paid the buyer pays the premium at the time that you enter into the transaction. So for the profit, we consider this premium as well. So you exercise your right only if it is a call option, you are a call option buyer. You exercise your right only if the market price is higher than the strike price. If it is lower than the strike price, you don't exercise your right because you can buy the underlying at a lower price than the agreed price, exercise price. So therefore, you won't get anything because of this call option. You just let the option to be expired. But there's a cost What is that cost? It is the premium. So therefore, until market price reach to the level of strike price, buyer of the call option incur a loss which is equal to the premium of the option. Then after that, gradually, when the price is above the strike price, you can exercise your right and get the payoff of this difference. But if that gain is less than the premium, still you incur a loss, but the loss will be lower than the premium. So therefore, gradually loss will be lowered after some point of price increase. It will give you a profit. So this is the profit diagram for a call option and from the buyer's point of view. This point we call it break-even point, which is equals to X plus P. P is the premium. If the spot price equals to X plus P, this difference should equal to premium. Then you get a zero profit. If the spot price is above this break-even point, buyer of the call option make a profit. So this is the profit diagram for the call option from the buyer's point of view. So therefore, there's a maximum loss and maximum gain. What is the maximum loss? For the call option buyer, maximum loss is only the premium. Wherever that loss, it is equal to the premium, this amount. That's the maximum. The buyer of the call option won't realize any loss beyond the premium. It is limited to the premium, but the profit increases with the spot price. When the spot price increase, profit also increase. So therefore, there's no maximum limit for the gain. It is unlimited. This is the summary of call option. So now, if we consider a put option, again from the buyer's point of view, what is the payoff diagram? Buyer of a call put option will exercise his right only if the market price is lower than the strike price, because he wants to sell the underlying. If the market price is higher than the strike price, he is better off by selling it at the market price. If the market price is less than the strike price, he is better off when he is selling at the higher price, that is the strike price. So therefore, buyer of a put option will exercise is right only if the market price remains less than strike. This when the market price is higher than the strike price, put option buyer won't exercise this right. But what would happen in this area? There will be a loss. What is this loss? That is again the same as the premium. What is the premium that he paid to buy that option? It is a cost, and therefore it's a loss. Then when the price decreases, loss is reducing again up to some point, then the loss will become a profit, and profit goes up. Again, this is break even. That is equal to x plus e. This difference is e. What is this? This is the maximum profit, which is equal to strike price minus premium, that is x minus e. For a put option buyer, there's a maximum profit which is equal to strike price minus premium. By the time you enter into the transaction, you know what is your maximum profit as a buyer of a put option. So these are the basics that we discussed last week. Today we are going to focus on this premium. What are the factors that affect to this premium and how? Basically, we are going to discuss that. Any questions? Can you see the presentation?
Yes, sir.
Yes.
You can see.
Okay. So, any questions?
No, sir.
Okay, then we'll move forward. So, we are going to discuss a little bit on premium. As I mentioned, what are the determinants of the premium, then the put call parity, then the sensitivity measures delta, and other option Greeks, again some sensitivity measures, because premium is sensitive for more than one determinants. Delta is only measures only one sensitivity, others are measured through other Greeks. We'll discuss once we discuss this, what are the determinants, then what are their sensitivities. So as I mentioned, option buyer, whether it's a call option or a put option, option buyer gets the right to buy or sell the underlying asset. And meantime, option seller has the obligation. Option buyer does not have any obligation, but the option seller does not have any right. So therefore, the writer, that means option seller, requires some compensation. That compensation is the premium, because option seller takes some risk by giving that option or the opportunity to make profit to the other party, the buyer of the option. to give that right, the seller takes some risk. Nobody would take any risk for free. They need some compensation for that risk. In the options, that compensation comes through the premium. So that is the price of the option. Premium is the price of the option that is paid by the buyer of the option to the seller. The premium is determined by the buyers and sellers in the flow or the market, depending on several factors. And as I mentioned earlier also, option buyer pays the premium to the option seller on the initiation of the contract, and it is non-refundable. The buyer cannot ask for that money back. What are the factors that affect the premium or determine the premium? The two key factors are strike price and time to expiry. There are more. Strike price and time to expiry. Time to expiry means what is the maturity period of the option. These are key factors. There are other factors also. So this will give you some idea how strike price and time affect the premium. So in the first column of this table example, it gives you strike price. 500 call means all are call options. Call means all are call options. 500 is the strike price. It may be 500 rupees or whatever you need. The strike price is 500. Then the premium for March expiry. That means the option is expired on March. Premium is 70. When the strike price is 500, strike price is 500, the premium is 70 for the March expiry. But if you extend the expiry by 1 month to April, for the same strike price, premium increases to 85. 70 to 85 premium increase. You extend the maturity, premium increases. So then you can see what is the relationship. Time, long expiry period, higher premium, positive relationship. But if you go down, you can see 500, 525, 550, 575, 600. So the strike price X increases. When you go down this column, you can see strike price increases. What happens to the premium? When the strike price is 500, premium is 70. When the strike price is 525, premium is 49. So gradually premium decreases. So remember, this is for a call option. Same underline, call option with different strike prices. For the same maturity, premium decreases when the strike increases. Why? Assume spot is today spot is 400. Less than the whatever the call price is given here. And until maturity next March, price can change. The buyer will exercise his right only if the spot price on March is above 500. So there's a long way to go from 400 to 500 and above 500 during next 6-7 months. So considering that chance, this price has been decided 70. Then the next strike is 525. What are the chances of spot price going above 525 during the same period? Is it higher than this going above 500, or that chance is less than less? So before you reach 525, it should reach 500. So the chances of increasing the price up to 525 is lower than the chance of price increasing to 500. Likewise, the risk is getting lower for the same maturity. Remember, for the same maturity, risk to the seller is less when the strike price increases. So therefore, the premium goes down. But what would happen when the maturity extended? Assume price of the underlying is 400 today. What are the chances of this 400 going to 500 by tomorrow and by 1 month, or by 3 months? Chances of getting this to 400 to 500 by during one day is very low. But in 3 months, it can happen. Chances are high. But in 6 months, it may be more than that. So therefore, when the time to expiry increases, the risk to the seller is high. Therefore, the premium increases. So time and premium has a positive relationship. Time to maturity and premium. When the time to maturity increases, premium increases. So this is the basic relationship. So with that, the premium we call, there are two components. The premium is decided based on two components. One is intrinsic value, the other one is time value. What is this intrinsic value? That is the difference between strike price and the underlying assets price. For a call option, you exercise your right if the market price is above the in this area only, you exercise your right as a buyer of a call option. What do you get? this difference, spot minus X. This value we called intrinsic value of the call option, and it can be never be negative. Why? It cannot be. To this difference to be negative, spot price should be somewhere here. In that case, you won't exercise your right. So the option has no value to the buyer, so you won't exercise. So in this area, when the X is higher than the spot price, intrinsic value equals to 0. But when the spot price is higher than the strike price, there's a positive intrinsic value. Buyer of a call option won't exercise the right when the strike price is higher than spot. Buyer will exercise his right only if the spot price is higher than the strike price. That difference is the intrinsic value. What would happen if it is a call option? The call option, it's the other way around. This is strike. S is less than X. Then the buyer will exercise his right. Buyer can, for a put option, buyer can exercise his right. Buyer can sell the underlying at the strike price X when the market price is S. This difference is the gain. So in this case, intrinsic value is X minus S, not S minus X. X is the higher figure. X minus S is, this difference is the gain. But when the market price is higher than the strike price, buyer of a put option won't exercise his right. So intrinsic value equals to 0. There's no value to the buyer of the put option when the market price is greater than X. So therefore, intrinsic value can never be negative. It's always positive. No, sorry, not always positive, either positive or 0. That's why we say it cannot be negative, but it can be 0. When the spot price is higher than the strike price for a call option, intrinsic value is 0, but it's not negative. When the strike price is higher than the spot price for a put option, intrinsic value is positive. So basically the intrinsic value is the difference between the strike price and the underlying asset. How do you calculate the difference? That depends on whether it's a put option or a call option. If it is a call option, that is the difference between spot and strike price. That means spot price minus strike price. For a put option, that difference we calculate as the strike price minus the spot price. So therefore, in summary, for a call option and put option, we can write intrinsic value as the maximum of spot minus strike or 0. So if the spot minus x is a negative figure, say -5 and 0, what is the intrinsic value? Intrinsic value is 0 because maximum of these two is 0, not -5. It is other way around, x minus s for a put option. So this is the summary what I explained earlier. So as a buyer of an option, buyer won't exercise his right unless there's a intrinsic value. Even when it is 0, there's nothing that the buyer would get if the intrinsic value is 0. So therefore mostly the option will exercise only if the intrinsic value is positive. Otherwise it may not, even at the 0 level it may not exercise. There's no harm of doing when it is at 0 level. But however, if the intrinsic value is, or there's no value for the option, the buyer won't exercise his right. And all options that have intrinsic value at expiry will be exercised, but as I mentioned earlier, that has to be triggered by the buyer. Buyer has to inform to the seller, so the buyer is going to exercise his right, otherwise it will expire without giving any gain. As I mentioned earlier, premium is not refundable. Once the buyer paid it to the seller, it is paid. You cannot reclaim that amount. And whatever the premium paid, it is not a factor to consider whether the option is exercised or not. On the expiry date, or if it is American option, even before the expiry date, the buyer of the option has the right to exercise his right, can exercise his right, has the right to buy or sell the underlying depending on the type of the option that the buyer has bought. But to make that decision, premium won't become a factor. Only factor is the relationship between strike and spot. For a call option, whenever strike price is less than spot price, the option will be exercised for a call option. But for a put option, it's other way around. For a put option, whenever spot price is less than strike price, then the option will be exercised. To take this decision, this is the relationship we have to monitor. Nothing to do with the premium. Remember that. No need to check what is the premium paid for any option and add that to the strike price or subtract that from the strike price to decide whether the option should be exercised or not. That is only a function of strike price and spot. The relationship depends on whether it's a put option or a call option. So therefore the buyer will realize in intrinsic value whether that will be offset the cost, that is the premium. That's a different thing. Sometimes intrinsic value may not sufficient to offset the premium. So in a call option profit diagram, it goes like this. If you can remember, this is X, this is spot price. So when the spot price remains somewhere between the strike and the break-even price, still you exercise your right, but it gives you a loss because the gain on this intrinsic value is not sufficient to cover the premium. Intrinsic value is less than premium. That can happen, but still you exercise your right. This will happen during this period. But here it's other way around. Intrinsic value is greater than premium, so you get a profit. This is for the call option. Same thing is true for a put option as well. So that's why it says if the intrinsic value is greater than the premium paid, the holder will make a net profit and the writer will make a net loss. What is the maximum gain for a option seller? Whether it's call or put, for an option seller, maximum gain is the premium. But depending on the type of the option that he sold, maximum loss will be different. But whatever the maximum gain for the buyer becomes the maximum loss for the seller. So based on that, we classify any option into 3 categories: in the money, at the money, or out of the money. This is based on the intrinsic value. So basically, in the call options, when the spot is higher than the strike, intrinsic value is greater than 0. What is intrinsic value? S minus X. This is spot price. Wherever S, that spot price remains, the difference is positive. So for a call option, when the strike price is less than market spot price, strike price is here, it is less than market spot price. In this area, we call the option is in the money because there's a positive intrinsic value. But when X equals to spot, that means exactly on this point, intrinsic value, in this instance, intrinsic value equals to 0. This we call at the money. There's no intrinsic value, or it's 0. That happens, strike price equals to spot price. Then The third area is when the spot price is less than the excise price. Still intrinsic value is 0. Remember, we discussed this. Intrinsic value never be negative. So it's 0. But here we call it out of the money. There's no gain for the buyer. No value. So still intrinsic value 0. But strike price is higher than the market spot price. So we call that out of the money option. The same option depending on the spot price and the strike price. It can be in the money option, at the money option, or out of the money option. Any option which is in the money today, it may become at the money option tomorrow, or may become out of the money option depending on the market price movements that can happen. So this is graphical representation. This way it shows the market price. Market price increases from left to right. In the middle, you can see the strike price. If the market price is less than strike price, the option is out of the money. Remember, we are referring to a call option. When the strike price equals to the market price, spot price, then it is at the money option. When the market price is higher than the strike price, it is an in the money option. So, same thing we can use for a put option, but in this line, this is X. So this is at the money. When the spot price equals to strike price, option is at the money. But in a put option, where do you get positive intrinsic value? You get the positive intrinsic value when the strike price is higher than the spot price for a put option. So this area is in the money, below this strike price. Strike price is greater than market spot price for a put option. That's the area the option is in the money. When the option is, or the strike price is less than the spot, still IV intrinsic value is 0, but is option is out of the money. Why? Buyer won't get anything by exercising his right, by selling the underlying at the strike price. He is losing. So therefore, at this instance, it is out of the money. So this is again in summary. From left to right, market price increases. Somewhere in the middle, the strike price is there. From the from strike price, the left hand side is in the money for a put option, right hand side out of the money for a put option. When the market price is equals to strike price, we said it option is at the money. So you can see if you take a same strike price and a call option and a put option, when the put option is in the money, call option is at out of the money. When the call option is when the put option is out of the money, but the call option is in the money. If we take a put option and a call option with the same strike, in the money and out of the money would be the opposite of the call option for the put option.
Sir, for one question.
Yes.
Put option in the sense option buyer have given right to sell.
Option buyer has the right to sell. Yes.
Yes. Okay. Then X in the sense strike price.
Yes.
He will get a gain when strike price is less than the spot price.
No, he will get the right. He will get a gain when the spot price is less than the strike price, because the right he gets, he can sell it at the strike price. When the market is here,
right. Okay.
he can sell it at the strike price, agreed price, not at the spot price. To sell at the spot price, you don't want any right. You can sell. If you have the asset, you can sell it. You don't want any other right. Only thing is you should possess the asset to sell. If you don't have the asset, but in financial markets, yes, still you can short sell. So therefore, no barrier to sell at the spot price.
Okay. Put options in the sense right to sell.
Right to sell, yes, at the strike price. Call option, right to buy at the strike price.
Okay.
Not at the market.
That means when we are getting to a put option, when the strike price, when the spot price is below the market price.
What price? Sorry, when you get a put option.
When you get a put option, when the strike price is greater than the spot price, we can sell.
You can exercise your right. You can sell it at the higher price, strike price.
Okay. Right.
So that then you get the difference as the profit.
Yes. Right. Okay. Thanks.
Okay. Anything else? Any other question? So we discuss about intrinsic value. Earlier we discussed premium equals to intrinsic value plus time value. We discuss about intrinsic value. How to get the time value? To get the time value, we take this into this side, then it would become the difference between premium and intrinsic value. The difference between premium and intrinsic value is the time value. But yes, then the question is, how do you calculate the premium? So we are not going to discuss how to calculate the premium in this course, but there are models how to calculate premium. One famous method is, there's a method called binomial tree based on risk-free rate and the probabilities of price getting at different levels. So one method is binomial tree. Other one is very famous model which is called Black-Scholes model. Black-Scholes. I don't know whether spelling of Scholes is correct. Black-Scholes model. That's a very famous model for option pricing. We are not going to discuss any of these models, but that's how you calculate the premium and intrinsic value the way we discussed. Then the difference is the time value. What does it reflect? The time value. What does time value reflects? That reflects the possibility or the probability that the price can move beyond given any strike during that time period. As I mentioned, for any underlying, so say take USDLKR. Now the current market price is about 187. Okay. What are the chances that would go to 200 in 1 week or in 2 weeks, 1 month, 3 months, 6 months? What are the chances? Is it likely to go to 200 within 1 week? No, it will be less. But in 2 weeks, 1 month, 3 months, yes. With the time span, the risk is higher. We don't know what would happen. So the time value reflects that. If the option expires in 3 months, the risk of that price moves beyond the strike is high. But if the strike, if the option expires very near term, that means within few days, then we know what would happen to the price. What are the chances of price moving above the strike or the below the strike, depending on the whether it's a call option or a put option. So the time value reflects that. So again, there's an example with different strike prices. Call PM is the premium, IV is the intrinsic value, then the time value. So you can see here the difference is time value. This is the premium. So in some premiums, there won't be any intrinsic value. It may be only time value. In some put, there may be, it may not be any intrinsic value. Intrinsic value can be 0, but still there may be time values. We'll move into examples, then I think you will get a better understanding. So this is This gives you a basic information about the option. It's a assume today date is 15th March. Forget about the year. No need to worry about that. However, today is 15th March. Same year. Option maturity is on May. So it's on the share prices of ABC company. It's a call option. So it's a call option on a share price. Price of a May call option is $35.75. What does it mean? What is this? $35.75 price. What is the price? That is the premium of the option. To buy that option, you have to pay $35.75 as the premium. Strike price of the call option is 66. That means you can buy the asset or the shares of ABC company at a price of 66 in May 2020. As of 15th March, spot price of the share price is 80.75. Not in May, in March. As at today, spot price is 80.75. The option premium is 35.75. So just calculate the intrinsic value and the time value. What is the intrinsic value? Intrinsic value is the, for a call option, it's the market spot price and strike price. What is strike price? 66. What is market spot price? 80.75. Spot price is higher than the strike price. So therefore this call option is in the money. So you should get a positive intrinsic value. The difference between $80.75, that's the spot price, market price, and the strike price 66, the intrinsic value is 14.75. The intrinsic value of the option is 14.75. But what is the premium? It is 35.75. The difference between the premium, the option price, and the intrinsic value is the time value. $21 is the time value. Why? We are still in March. 2 more months to go until May. There's a chance that spot price may increase further. So with that, there's a risk to the seller of the call option. That risk is reflected in the time value of the option premium. Is it clear? With given information, premium, strike price, and spot price, how to calculate the intrinsic value and the time value. The next example, it's on a put option. Again, we assume it's on the, we are in March, and the put option is for May. Again, it's on shares of XYZ company. Price is 70. Price of the option is 70. Premium is 70. Strike price 378. And the spot price is 310. Is this option in the money or out of the money? This option, is it in the money or out of the money? This is a put option. This is an put option. Strike price is 378. Spot price is 310. Is it in the money or out of the money?
In the money.
In the money. Why?
Because strike price is higher. So he will
Strike price is higher than the spot price. That means is 378, which is strike, is higher than 310, which is spot. And important thing is this is a put option. So you can sell it at 378, whereas the market is now only at 310. So the intrinsic value is, what is the intrinsic value? It is 68. The difference between 378 and 310. So the option is the money. Intrinsic value is $68. Then what is the time value? Option premium is 70. Intrinsic value is 68. So time value is just 2. The difference between premium and the intrinsic. And price 70, this is the premium, 68 intrinsic value. The difference is $2. Is it clear? So then we'll move into what are the factors that, or the determinants of the premium. These two things, time to maturity and price of the underlying asset, we discuss now. The time to maturity, yes, that will have an impact on the premium. Price of the underlying asset, yes, that is also we discuss. The other thing is volatility, interest rate and dividends or coupons. That depends on the type of the instrument. There may be some underlying which does not give any interest or any dividends, any coupon income or nothing. So for those asset underlying, these factors will not affect, but still interest rate may have an impact on the option premium. So time to maturity, as we discussed, a longer dated option will have more time value than a near dated one with the same strike. Why? Because of the risk. Risk is high. The price can move either way when there's a long period. So therefore, longer the time period, higher the risk. So there's a more time value in the option. But what would happen with time passes? So assume now it's August. We enter into a option contract, matures in December. We have almost 4 months. Initially, there's a 4 months. The time value will be high. But when we come to the end of August, there's only 3 months remaining. So the risk is somewhat lower than when we have it for 4 months. So therefore time value will go down. We call it leaks away. The time value gradually reduces with the time passes. So we call it for the time decay as well. And the speed at which that erosion take place, or the decay factor, it is not constant. At the beginning, the time value will go down gradually by small amounts, but when it very closer to the expiry, time value goes down at a higher rate. So therefore, the relationship between time value and the time to expiry will be like this. So indeed, this x-axis, it is not time to expiry. So this is expiry date. Consider likewise in that sense. So this is today, this is expiry date. Today time value is somewhere here. After few days, it will be somewhat lower, but only by very small amount. But if you take the same distance here, the decrease in price or the time value is much bigger. So when it gets closer to expiry, time value decrease at a higher rate. On the expiry date, there's no time value. It's 0. On the option premium, or the value of the option will be decided by the intrinsic value. If the option, there's an intrinsic value, option will have a value. If there's no intrinsic value, option won't have any value on the expiry date, because on the expiry date, time value is 0. With the time value decreases. Initially, the rate of decrease is low, but with the time, rate of decrease increases. When it comes to the closer of expiry date, time value decays very fast. So therefore, as an option buyer, the time value works against him. Value of the option will go down with the time. Only if there's any intrinsic value, then only you get some value. So therefore, this erosion work for the seller of the option or the writer of the option. Because he has sold an option, the value of that option goes down with the time. He can buy back it at a lower price. Then the other factor is price of the underlying. That is but what really matters is the distance between the strike and the price of the underlying, because this directly affects the intrinsic value. This directly affects the intrinsic value that might have impact on the time value as well. Say for a call option, when the X is here, when the spot is here, this distance is the intrinsic value for a call option. If this is very small, the value of the premium will be very small. That depends on the time value as well, but the added component to the time value will be very small. But what would happen if the spot price is somewhere here, far away from the strike. In this case, intrinsic value is much higher than the previous case. So the option premium will be high. So the other thing, this sort of thing, when the spot price is far away from the strike, we call it deep in the money or deep out of the money. So in this case, it's a call option. This spot price is far away, much higher than the strike price. So the call option is deep in the money. Now the chances of getting this spot price below the strike is less. So the option is in the deep in the money. Bulk of the premium will be decided on the intrinsic value than the time value. On the other hand, if the spot price is somewhere here, well below the strike, then we call it deep out of the money. The chances of getting that option to in the money is very low. So that's why this distance matters, not the just spot. The difference between strike and spot matters in the premium. So in the money options have a high probability of exercise because it's already in the money, especially when the time is very low, the chances are high. Deep in the money options, chances are very high to be exercised. So for the in the money options, there's less uncertainty about the outcome. So there's less time value. In the premium, most of the premium will be based on the intrinsic value rather than the time value when the option is in the money. But when the option is out of the money, but still there will be a time value. So assume this is strike. This is spot today. There's a difference. Assume a call option. Intrinsic value is 0. But what would be the premium? This is not the so still 3 more months to go. Still three more months to go. This is the situation as of today. Spot price is less than strike price. So therefore intrinsic value is 0. What would be the premium of this option? Is it 0? No. Still there will be a premium, but that whole premium is decided on the time value because there's a chance within these 3 months this spot price can move to a higher level. Price may increase beyond the strike price. So that chance is there, that uncertainty is there. So therefore, even the option is out of the money, but still there's some time to expiry, there will be a premium for that option. Then out of the money options have a high probability of being abandoned. That means let it expire. When the option is out of the money, it may remain as it is as out of the money option and it won't exercise on the maturity date. So there's a very small chance of exercising it. The value is, intrinsic value is 0, but therefore only the time value be there. But at the money options have the highest amount of time value because it's exactly on the spot exercise price. Spot price is exactly on the spot price. We don't know whether next day it will go above the strike or below the strike. So uncertainty is very high. Therefore, the time value is at its maximum level when the option is at the is an at the money option. Then the third factor is volatility. So I'll explain that. So in previous examples, I consider say $187 rupee and 200. I ask you, what do you think? Within 1 week, 1 month, what are the chances of that dollar rupee exchange rate goes from 187 to 200? The chances are higher in 1 month time, that's true, than 1 week because we don't know within a 1 month what would happen. Same thing, even if 450, say, the chance of getting it lower to 150 in 1 month is much higher than the chances of getting it to 150 within a 1 week period. That's true, but there's another factor that will have an impact. That is volatility. What is this volatility? How quickly price changes and what is that deviation? Say, if you take the dollar rupee exchange rate within a day, have you seen within a day that dollar rupee exchange rate changes by 5 rupees? No, it may be few cents. But what would happen if it is changed by 5 rupees within a day? So even within 1 week within a 1 week frame, there's a high chance of moving it to 200 when the price changes are high. 10 cents and 5 rupees. Within a day, you should generally assume dollar rupee exchange rate changes only by 10 cents. And the other scenario, within a day, dollar rupee exchange rate changed by 5 rupees. So huge difference. So when the changes are much higher, increase or decrease by a large amount, going towards the exercise or going away from the exercise price is much high. So this volatility also a factor in deciding the premium. High volatile market, that volatility means price increase, decrease very quickly and by large amount. That is volatility. If the price moves by large amount, volatility is high. That means uncertainty is high. Volatility is measured as the standard deviation. It's a statistical concept. You might have heard about it. Standard deviation. Volatility is measured as the standard deviation. That means from the mean value, how far the price can change. If it is high, the risk is high. The price can change very quickly from the existing level for a far away level. So therefore we call volatility, that is volatility. Volatility is high. So therefore the risk on the options is high. Therefore the premium is high. So the volatility, when the volatility increases, premium also increases. When volatility increases, premium increases. Whether it's a put option or a call option, irrespective of that, when the volatility increases, premium increases. So therefore, this is also a very important factor. Even though I mentioned at the beginning, there are two main factors: price of the underlying and the time to expiry. Yes, this is also a very important factor, volatility. Because just because of the volatility, premium prices or the option prices, that is premium, can vary very quickly. Then how do we measure volatility? There are three types of measures: historical volatility, or based on a simulation, this futuristic view, or implied volatility through the options that already trade in the market. If you can collect option premiums traded in the market, you can do the reverse calculation given the what is current market price, what is the strike price, do a reverse calculation and calculate the volatility. That is called implied volatility. Do simulations and have a forecasted volatility, that is futuristic volatility. And historical volatility is you just take the prices of the underlying asset in the history and calculate the standard deviation, that is the historical volatility. So however, we are not going to discuss how to calculate volatility here, but just to let you know, there are different ways of calculating volatility. But the important factor is this: the relationship between volatility and the premium. When the volatility increases, option premium increases irrespective of whether it's a put or a call. That is important. Other factors are interest rate, dividends, and when very rarely, what is the currency of the premium payment? In which currency you pay the premium, that also matters. Because sometimes, even though, say, for an example, euro-dollar exchange rate, the option is on euro-dollar exchange rate. Whether you make the premium in euros or dollars, that can happen. And premium can pay either in dollars or either in euros. So that matters. Based on that also, premium amount may vary. However, just to know, this is a factor. And dividends, when there are dividends on stocks, generally premiums are low. But we'll discuss little bit on this. Interest rate and call option, there's a positive relationship. That means if the interest rate goes up, premium of call options increases. If interest rates, if I denote interest rate as R increases, then the premium on call options increases. What is the reason? Why do you buy a call option? You think price of that underlying increases, is going to increase. Price of that underlying is going to increase. So you buy a call option. What do you pay? Just the premium. But assuming that price will increase, if you have to buy the underlying, you have to invest a lot of money to buy that underlying. Invest a lot of money means either you have to borrow that amount or there's an opportunity cost. If you use your existing money to buy that underlying, you lose interest on that funds. But if you have to borrow, you have to pay. So there's opportunity cost if you buy the underlying. When the interest rate is high, that opportunity cost is high. But instead of buying that underlying, what you can do, you can enter into an option. Still you get the same, almost same gain if the price of the underlying asset increases. So during interest rate high times, instead of buying the underlying, the tendency to buy the call options increases. Due to the demand for the call options, the price of the call option increases. So therefore the premium increases. That's why the relationship between interest rate and call option premiums are positive. You can save interest cost on buying the underlying. Cost of buying underlying, you can save that cost through options, call options. But put options, it's other way around. In put options, you ask for the right to sell. If you sell, what would happen today? If you sell the underlying today, you get a cash flow. You receive funds. Then you can invest that funds at the current market interest rate. If you think prices will go down, would you prefer to sell it today or buy a put option? You can do either. Yes. What would happen if you sell the underlying today, you get the cash flow, you can reinvest that cash flow at the market interest rate. So if the market interest rate are high, you prefer to sell it today and invest that cash at the market rate to earn a high interest income. But instead, if you buy a put option, you forego that interest income. So therefore, when the interest rates are high, demand for put options is less. So therefore, premium of the put options goes down. So that's why you see a negative relationship between interest rate and premium of put options. So again, remember the relationship between interest rate and premiums of call options and put options. So these are the other factors that I wanted to highlight, which have an impact on the premium. So this is the summary what we discuss. Factors: price of underlying, time to expiry, volatility, exercise price. So indeed, price and the exercise price, that difference matters. Then the time to expiry, volatility, and the interest rate. But this interest rate impact what we explain is on physical. If you have to buy the option on the on futures, there won't be any impact, because you are, whether you are buying a future or the option, there's no interest cost. But whether you buy a physical asset or option, there's a difference. So in summary, if the underlying price of the underlying increases, call premium increases, put premiums decreases. Time to expiry, irrespective of the whether it's a call option or a put option, premiums increases. Volatility also same, irrespective of whether it's a call or a put, premium increases. But exercise price, if the exercise price is higher, call premiums decrease, put premiums increases. And the interest rate on physicals, that means straight away on the underlying, if you buy the option on the physical underlying asset, then for premiums for the call options increases with interest rate. Premiums on put options decreases with when interest rate increases. But if it is options on futures, no change in call premiums or put premiums, even though interest rate increases or decreases. Because buying premium or futures, it won't that much have an impact on the futures and options. There's a small concern here. In futures, you have to keep margin. For that margin also, still you earn interest. Therefore, it is not that much a concern. So that's all about premium and the factors that have an impact on the premium. If you have any questions, please ask. If you don't have any questions, we can if you don't have any questions, I think it's better we'll take the break here. After the break, we can start to discuss put call parity. So is it okay? If you don't have any questions, we'll take the break.
Yes. At what time we meet?
Sorry?
At what time we going to meet?
Yes, we'll take a break of 15 minutes. No,
Okay.
yes. Before we move into the next topic, is there any question? If not, we'll continue. Put call parity. This is very important concept, because this will reveal you whether there's any mismatch in pricing of call option or a put option or the underlying asset in the market. So basically at the end, you will be able to decide whether there's any arbitrage opportunities. So in simple form, this is the put call parity. What are the terms here? C refers to call premium, P refers to put premium. So all the time up to now I use just P for premium, but from this point and onwards I'll use C for the call premium and put for the put premium, and S is the spot price of the underlying asset and K is the strike price. Earlier we used X as the strike price. It doesn't matter whether you use K or X, but important thing is you should remember what are these terms. Premium on the call option, premium on the put option, spot price and the strike price. So in the intuition behind this, call premium is positive. That means you buy a premium, you buy a call option. This indicates that you buy a call option minus P, that is you sell a put option, you buy a call option and you sell a put option. That outcome is equal to positive ways. That means you buy the underlying and you borrow the strike price. So that is the underlying here. However, we'll move through this equation each and every term and what does it mean, then you will get to know more about this. This formula, put call parity equation as given here, this is applies to all options with the in whatever the underlying asset, whether it's American option or a put option, this applies to all options at expiry. Remember that. This equation applies to all options at expiry and to options on futures at all times. For futures, this equation applies anytime, but other options only at expiry. But we'll modify this equation for any option, which can be for any options. We'll modify this equation, which can be used even before the expiry. But first we'll go through this and understand what are the terms. So we'll go through this example, then let's see. So if the futures price is 100.95, the strike is 100 and the call option on the futures premium is 1.07, the price of the put option on the futures can be calculated based in using this equation. So what does it what are the information given out of 4 variables: call option premium, put option premium, spot price and the strike price. When 3 variables are given, you can calculate the 4th variable. So here, what is the underlying asset? Underlying is a future. This is the underlying. Underlying is a futures contract. Current market price is spot 100.95. So this is the spot price or the current market price of the futures. In this example, to do this calculation, we need not to worry about what is that real underlying. Because futures, there should be an underlying. We don't worry about it. For the option, the underlying is a futures contract, of which the price is 100.95 as of now. Then the strike price of the call option and put option. That's the other important thing. There's a call option, there's a put option. Both should be on the same underlying and with the same expiry date and same strike. Same underlying, same expiry, same strike. Then only this put call parity holds. So the strike is 100. That means K is 100. If you summarize whatever the given information, spot is 100.95. Strike price is 100. Call option and the call option on the futures premium is 1.07. Call premium is 1.07. This is what we have to calculate. Okay. Given this information, tell me whether the call option is in the money or not, or out of the money. Call option, is it in the money or out of the money?
Out of the money.
Huh?
Out of the money.
Call option. Then the put option.
100. Put option. In the money.
Put option in the money, out of the option, sorry.
Yes, yes.
Put option in the money, call option out of the money.
Yes.
Any other answers? Okay. Why do you call that call option is in the call option is out of the money?
Because the call option is that is right to buy. The strike price is 100. There the market price is 100.95.
Okay.
Then
what do you do?
Exercise that we can buy at 100 if we exercise.
Yes, they can. The buyer of the option can buy at 100, whereas the market price is 195. So the option is in the money or out of the money?
In the money.
Yes, call option is in the money. Call option is in the money. If the call option is in the money, definitely with the same strike, put option is out of the money. So what is the intrinsic value of the call option? .95. That's the difference between spot and strike. That is 0.95. So the call option premium is 1.07. So the difference 0.12 is the time value. Okay, up here our target is to calculate the premium on the put option. So we use this equation. We have these figures, just substitute. World premium is 1.07. Put premium, that is unknown, that what we have to find. SC is the spot price, 100.95. K is 100. So when you calculate, it should be P, not K. It should be corrected as P. P should be 0.12. Premium on the put option is 0.12. Clear? This is wrong.
Yes, sir.
We'll move to the other example. If the futures price is 101.5 and the premium for a call with a strike of 110 is 12, what is the premium for a put with the same strike? Again, futures price SC is given. K is given 110 and premium of the call is given, C is 12. What is the premium for the put option? Again, you can substitute here. C is 12. P we don't know. S is 101.5. K is 110. So the answer is premium is 20.5. Remember, this is correct on so since this is futures, this is correct anytime. But for others, this put call parity equation in this form holds only on the expiry. So for options on futures, the underlying asset is a future itself. Therefore, no cost of carry, because you don't invest anything to buy a future. So that's why we don't want any adjustment for the time factor, when to excise and what is today. But you don't have to consider that timing factor. But for others, this put call parity is need an adjustment to consider the cost of carry, because to another put or call option, someone may have to buy the underlying asset or sell the underlying asset. So there may be a cost on that, or you may need investment. So therefore we need an adjustment for this put call parity equation if we want to use it before the expiry. In simple, that adjustment comes in the strike price. What we do, because we get this strike price on the maturity date, but if we are in before the maturity date, there's a cost time factor that we have to calculate. So what we do, instead of using strike price as it is, we use the, what is this? This is the present value of the strike price. So we discounted the strike price at the market interest rate for the remaining maturity. In this equation, T is in years, but when you substitute figures, you may have to use decimal figures if it is less than 1 year period. So therefore, this is the general put call parity equation where you can use for any asset, any underlying asset other than futures, and in any time during the lifespan of the option contract. So we'll do some examples in that. Again, it's on shares. Shares price is 600. That means spot is 600. Put premium is 500. In this strike is sorry. Strike is 500. Premium, put option premium is 7. Option expires in 3 months. So now we need this T, 3 months, and R is 6%. So these are the information given. The question is, what is the call premium for the same strike, 500 strike? So the option expires in 3 months. So remaining time to maturity is 3 months. So in summary, these are the information given. Spot price is 600. Put premium is 7. Strike is 500. Time to maturity in years, 3 months means 0.25. Interest rate is 6% or 0.06 per annum. So this is the equation which we can use to for any underlying asset at any time. So just substitute the figures. P is 7, S is 600, K 500, interest rate is 6%, and time to maturity is 3 months. Calculate it, you get 114.23. That is the premium of the call option. So you can see premium of the put option is very small. Premium of the call option is very large. Why? This call option is in the money. Strike is 500, spots 600. So for the call, IV only, it's 100. For this call, intrinsic value is 100. The 14.23 other part is the time value. In the put, it's out of the money. So this is only the time value of the put option. There's no intrinsic value for this put option, it's 0. So this premium contains only time value. But whereas this premium of the call option contains time value plus intrinsic value. So this 100 comes as the intrinsic value. This is call option is in the money. We'll move into another example. So this is S, shares of XYZ trading at 410 pence. And the premium for the 400p call option that expires in 2 months, time is 2 months. What is this 400p? That is the strike. What is this 25p? That's the C, premium for the call option. But the question is, what is the premium for the put with the same strike when the interest rate is 3%? So again, here we have the summary of the information given. This time in this should be C instead of P, because call option premium is given, not the put option. Then let's see whether this should be called put premium or the call premium. S is 410, K is 400, so it's in the money. Call option is in the money, so C should be higher than 10. So this is call. Yes. So it's correctly substituted here. You can see C is 25, P is, which we don't know. Strike is 410. Strike is 400. Interest rate is 3%, and time to expiry is only 2 months. So in years it's 2/12. So the answer is 13.03. The premium of the put option is only 13.03. Again, this call option is in the money, so therefore put option should be out of the money. Again, this is only the time value of the put option. So likewise, whenever you are given 3 factors, fourth one you should be able to calculate. So it can be the strike. You are given the call option premium, put option premium, and the spot rate. Then you will be able to calculate the strike price. Or you are given strike and 2 premiums, you should be able to calculate the current spot price. So the important thing is, if the call and put premiums are not consistent with the put call parity, then there's a arbitrage opportunity. Somewhere something wrong. So there's a mispricing. So there's a arbitrage opportunity in this. Say for example, in this example, when you calculate, you see premium of the put is should be 13.03. So assume you go to the market and check what is the premium for this put option. It says 15 in the market. Put option premium is 15, whereas given this information, when you calculate, it should be 13.03. What does it mean? Something wrong in the market somewhere. Either put option is not properly priced, or the call option is not properly priced, or maybe the interest rate. Something wrong. We don't know which is correct, which is wrong, but something wrong. But so there's an opportunity for us to do an arbitrage trade and make a profit. In this instance, what do you do? again go back to our basic rule that we discuss even in FX in arbitrage. What do? Buy low, sell high. So what do? Your implied premium is 13.03, market premium is 15. So market price is higher than the implied rate. So therefore you sell this option at the market. You sell this option at the market price. Then what do? You have to synthetically buy a option, put option. How do we do that? So we'll discuss it here. There are two strategies: reversal or conversion. Reversal. If the call is relatively cheap, what does it mean? C calculated is less than C market. If the call option premium according to the put call parity is lower than the call option premium in the market, then you buy the call option from the market and sell the put option in the market and sell the futures contract. Then hold it until maturity. You make a profit wherever the market on the expiry date. Conversion is for put options. If the put is less than market put premium, as I explained in that example, in this instance, what do? Put is relatively cheap. So that means in the market put is even here, yes. In the market, call is cheap. So then buy the call from the market and do this transaction. Here in the market, put is relatively low than the put premium indicated in the put call parity. So you buy the put option from the market and sell the call and buy the futures. So what do we do? C minus P equals S minus K. If you want to make it call option, C equals S minus K plus P. So here you buy the call. You buy the call option from the market. Now what do you have to do? Sell a call option synthetically. This equation tells us call option is equal to spot, basically long futures and a long put option. Together this S minus K we can consider as or even S we can consider as we are going long the underlying and going long a put. So therefore what does it reveal here? long a future or the underlying, long put. We do this, which is equal to buying a call option. Similarly, we can write put option as C minus S plus K. What does it mean? Put option is equal to buying a call, selling the underlying C minus S. So here in this strategy, since the call option premium in the market is lower than the premium implied through the put call parity, we buy the call option from the market. Then we have to synthetically sell the call option. So this is the call option, synthetic call option, this part. If you want to sell, we change the signs. Then it becomes short call. You are selling a call option, which is equal to sell the underlying, sell the put option. That's why it says here, sell the put and sell the future, because the underlying is a future. The same concept applies here. You buy the put option from the market, so therefore you need to sell a put option through call and futures. To sell a put, this is the put option, which is put option is equal to long call and short underlying. But if you want to sell a put option, we have to reverse it, short call and long future underlying. So that's why we sell the call option and buy the futures. So that way we can use put call parity to identify whether they are in arbitrage and do the trades and explore the arbitrage opportunities. So you need to understand this equation properly. Long call, short put equals to long underlying and borrowed money. To buy this underlying, you need to borrow money. That's the concept behind this put call parity. So if that parity does not hold, that means there's an arbitrage opportunity. You can do a reversal or conversion depending on whether it's a call or the put. Okay, then we'll move into sensitivities. We discuss about option premiums and different determinants. What are the determinants of premium? Premium depends on strike and spot time to expiry. What else? Volatility and interest rate. So we'll discuss how this premium changes in these variable, that is sensitivity. sensitivity of option price or the option premium for these variables. If you go back to fixed income securities, can you name a sensitivity measure that we learn in fixed income securities? Sensitivity of fixed income price bond prices to interest rate. What is the measure that we use? In fixed income, what is the sensitivity measure that we used? Bond prices are sensitive to interest rate. To measure that sensitivity, what is the measure that we use? Sorry? Value at risk? No. It gives you the risk or the loss, maximum loss, or the sensitivities we measured through some other measure. That is duration. He specifically said modified duration. How do you interpret the modified duration? What is the percentage change in bond price for a 1% change in interest rate change? What is the percentage price in change? Sorry, percentage change in prices for a 1% change in interest rate. That is measured through modified duration. It is a sensitivity in fixed income or bond market. So likewise here in the bond, prices are sensitive for the interest rates only, but here premiums are sensitive for all these, but not the strike, because it's a static figure. So the first measure is delta, like duration, and we had the convexity as well, but which is equivalent to duration in option is delta. For the change in spot price, what is the change in premium is measured through delta. So that's why it's a measure of the sensitivity of the options price to changes in the price of the underlying asset. But in modified duration, we calculated it as a percentage of the existing price, but here it's not as a percentage. So this is the equation. What is the change in option premium for a given change in price of underlying? So therefore, delta, we can interpret delta as if the price moves by $1 or 1 rupee, whatever the unit of currency, by 1, what is the change in value of the option? Not as a percentage change of value, but this is the value of the, what is the change in the value of the option for a change in $1 of the underlying price is measured through delta. So for call options, delta is positive. Why? If the underlying price increase, price of the underlying asset increase, what would happen to the price of the call option? If you can remember, if you go back to this, the relationship between price of the underlying as call premium is positive price. When the price of the underlying rises, call premium rises. That means when the price of underlying decreases, call premium decreases. So there's a positive relationship. But with the put, there's a negative relationship. When the prices of underlying asset increases, call premium increases, whereas put premiums decreases. So there's a negative relationship. That's why in delta, the sign comes in that way. For call options, delta is positive. For put options, delta is negative. The reason is premium rise when the price of the underlying rise. So therefore, delta remains between 0 and 1. In an option, if you go back to the profit diagram or payoff diagram, you can remember. So if you get the payoff diagram, it was like this. Payoff diagram. When it is out of the money, call option, you won't get any payoff. But the moment it comes in the money, value of the option increases. But if the price increase by $1, option value also increase only by $1. But this is true only at the expiration, on the maturity. Before that, it will be a curve like this. However, it won't be more than 1. Assuming other factors remain same. No change in volatility, no change in time to maturity, nothing. Only the price of the underlying asset changes. The call option price would increase maximum by the amount of the price change, not by anything else. So that's why it remains 0 and 1. It's positive. For a call option, it's positive. For a put option, it's negative. Then and it remains between -1 and 0. So we'll move into an example. ABC PLC share price 575. That means again this is on equity based on the shares of a particular firm. Price is 575. This is spot price. The 625 call. What does it mean? 625 is the strike price as a delta of 0.3 and a premium of call premium of 26. And there's another option. It's a put option. This is the strike of put. This is the strike of call. Delta is -0.3 because for a put option, if price increase, value of the put option decrease. So therefore, sign of the delta is negative. Premium is 24. Now the question is, if the share price rises to 585 from 575 to 585 by 10 units, what would be the new prices of call and put options? Strike price, sorry, spot price has changed, increased by 10. What would happen to call price? What would happen to put price? Just tell me the direction. What would happen? Spot price has increased from 575 to 585. Premium of the call, would it increase or decrease? Premium on the call, would it increase or decrease? Price of the underlying has increased.
Premium decrease.
For a call option, spot price increases, what would happen to C? That means premium. Increase or decrease?
Decrease.
Decrease. Why?
Strike price reduce.
Okay, consider this example. Now the price is 575. Strike is 625. The price moves from 575 to 585. So that means the price getting closer to the strike. Is it good for the call option buyer or is it bad?
Yeah.
625 here, 585 here, 575 here. You are a buyer of call option. Price of the underlying asset increase from 575 to 585. Is it good for you as a call option buyer or bad?
Bad. Bad.
Bad. Why?
You lose. Like
How do you lose?
lose in the sense if we exercise it, we can exercise it at 575. So sorry, since the market.
What do you mean by exercise at 575? You are a buyer of a call option with a strike of 625. What does it mean? You are a buyer of a call option with a strike of 625. What does it mean?
You have a right to buy at 625.
625. Okay. Now the market is 575. As a call
Yes.
option buyer, is it good for you or
Bad.
Bad. So when
Bad.
the price increase 575 to 585, is it good or bad?
Good.
Good. Why?
Because price is closer to strike price.
You are going towards the getting closer to the strike price. You prefer as a call option buyer to price to be in this area, in the money.
Yes.
Now you are in out of the money region. You want to move into in the money region. So when the price increases, that's why when price increases, price of the underlying increases, premium of the call option increases. That's the basic concept, principle. So therefore, increase in the price of the underlying is good for call premiums, but it is not good for put options. 525 is somewhere here. So you are going further away from your strike, 525. This side is out of the money for a put option. Spot price is higher than the strike, so you are out of the money. When price increases, you are moving into deep out of the money. So that's bad. So that's why even in the delta you can see this is positive, this is negative. No need to be same figure. That may be a different story, but sign gives you the relationship. When the delta positive, what does it mean? When the price of the underlying asset increases, price of the option increases. So it's positive for call option, negative for put option. So you should expect call premium to increase and put premium to decrease. Then you do the calculation, then you can check whether you got the answers in line with that your expectation. That's one way of checking whether you have done the correct thing. Still there may be wrong answers, but at least the direction you get is correct. So to answer that, we'll summarize what has happened. Share price has risen by 10 because initially it was at 575. It moves to 585. Delta of the call option, which is given 0.3. So change in the call premium is 10. The change in the price into delta. If you go back to this equation, delta is the change in option premium divided by change in price of underlying. So now we want to calculate the change in option premium. Then change in option premium is equal to delta times change in price of underlying. This is change in underlying. This is delta. So this is change in call premium. So call premium will change by $3. What was the previous premium was 26. Remember, this is only the change plus change. So therefore the new price is 29. It increased from 26 to 29 as we expect. In the put option, delta is minus 0.3. So therefore we expect price decrease by $3. 24 minus 3, new premium is 21. Option price, put option price decreases when price of the underlying increases. Again, this is an approximation because when the price moves from 575 to 585, the sensitivity or delta also changes. So therefore, again, this is only an approximation. So this is a summary. For futures, delta is always plus 1. If the futures price change by 1, option price also changes by 1. Deep in the money call, the change is plus 1. Say because strike is here, spot is here. So deep in the money, if spot price increased by 1, the intrinsic value will increase by 1. Exactly. Because it's deep in the money. No, we discussed earlier in the deep in the for a deep in the money option, time value is very small. So therefore, when it comes to deep in the money, time value is very small, intrinsic value is high. So when the price of the underlying increased by 1, intrinsic value also increased by 1 exactly. So therefore it's plus 1. But for a put, it's other way around. When the spot price increases, option value decreases. So therefore, the delta is -1. But for out of the money call or put option, delta is 0. Consider this is as a put option. Strike is here. Now the market price is much higher than the strike price. So even this decreases still in the out of the money region. When the option is out of the money, we discussed earlier, there's no intrinsic value. There's only time value. When the option is out of the money, premium contains only the time value, no intrinsic value. So therefore, change in the spot price, there won't be any changes to the premium. So therefore, when the out of the money call for out of the money call or put, delta is 0, and at the money call and at the money put, delta is 0.5. If it is a call, it's a plus 0.5. If it is a put, it's a minus 0.5. So the sensitivity is 50-50. It can falls into in the money or it can fall into out of the money when it is already in at the money stage. So this is premium. In questions you might see at the money option and blah blah blah. The delta is not given. You will be asked to do some calculation, but you need delta. The delta factor is hidden in the word at the money. You should know if the option is at the money, if it is a call option, delta is 0.5. At the money put option, delta is minus 0.5. Or in the deep out of the money, deep in the money, out of the money, then you should know these are the delta figures that you have to use. If the delta is not given, go through the question carefully, find out whether these deep in the money, out of the money, or at the money words are given in the question. Based on that, you should be able to identify the delta, relevant delta for that. We can use that delta to calculate the for a portfolio of option positions. Earlier, here we discussed how to calculate the price or the premium changes for a particular option, one option. But you might have a portfolio of options. That means collection of options, collection of put and call options together. How do you calculate the sensitivity or the price change, value change of that portfolio? So for that, first we have to calculate something called directional bias. That means whether when price increase, value of your portfolio increases or value of your portfolio decreases. So to do that, you have to consider long position and short positions in your portfolio, which is we call directional bias. When you have long positions, we use plus. When you have short positions, we use minus. So for an example, an investor is short an ATM. What does it mean, ATM? That is the short form of at the money. ATM means at the money. So this is an at the money put. What is delta? If it is at the money put, what is delta? It is minus 0.5 because it's a put at the money. So this is the delta of this premium. You should recognize it immediately. And the net delta position of this option is, this is directional bias -1. It is because of you are short, irrespective of whether it's a put or a call. If you are short, we add that directional bias minus, and then we multiplied that by number of positions. So you have just one position, one option, one put option at the money short. So -1 is just to show that you are short. This is number of positions that you have. This is delta. So your net delta would be +5. Why? If price increases, price of the underlying increases, what would happen to put premium? It goes down. But you are a seller of an option. As a seller of an option, you have collected the premium. Now, with price increase, premium value goes down. If you want to buy it back, now you have to pay a small premium. So it's a gain for you. As a seller, when the price goes down, it's a gain. That's why here you get a +0.5. Net delta of a short ATM put is +0.5. This is an example to show you how to calculate the net delta of a position depending on whether you are short or long. Now, if the price of the underlying rises by 10, what would happen? Your position improves by 5. 0.5 into 10. Your portfolio, option portfolio, will give you a $5 profit. When the price of the underlying increase, value of your portfolio increase by 5 because you have sold the option. But if you have bought the option, it would be other way around. There's another example. Long 5 in the money calls with delta 0.7. So it says in the money, but it doesn't say deep in the money. So therefore the delta is given. And long. So therefore directional bias is +5. 5 contracts and delta. The net delta of the position is 3.5. What does it mean? If the price of the underlying increased by $1 or 1 rupees, value of your option portfolio increased by $3.5. That is your net delta in this example. So now assume this is your portfolio. You have long 10 futures contract. So you know for a futures options on futures, delta is 1. So you have position futures contracts and short calls delta 0.13 out of the money call. Long put 4 puts contracts. For puts, delta is negative -0.65. How do you know whether it's in the money or out of the money? Just by looking at delta. So 0.5 is here for a call, assume for a call option. Delta is between 0 to +1. For a call option, delta is between 0 to +1. Delta is 0.5 when the option is at the money. When the option is out of the money, deep out of the money, delta is 0. So this is deep out of the money. OTM means out of the money. Delta is 1 when it is deep in the money. So whenever delta of a call option is in between 0.5 and 1, what does it mean? The option is in the money. When it get very close to 1, it's deep in the money. When ATM, when the delta is less than 0.5, what does it mean? The call option is out of the money. When it's very close to 0, it is deep out of the money. The reverse is true for a put option. That means when the option, when the delta is very close to -1, it is deep in the money. When the premium is very close to 0, it is deep out of the money. So that's why call options, delta is 0.3, it is out of the money because this 0.3 is less than 0.5. So the call option is out of the money. There are long puts for put options. Delta is -0.65. What does it mean? That option is in the money, which is the delta is less than -0.5. So therefore, it is in the money. There are another put options, 5 put options with a delta of -0.15. That means the delta is smaller than 0.5, but it is negative. That means it is a out of the money put. There are long 8 calls with delta equals 0. As I mentioned, when the delta is equals to 0, it reveals that it's deep out of the money call option. So we have this information. Now try to calculate what would be the net delta of this portfolio. So what do we have to do? We have to calculate net delta for each and every portfolio and sum them up. So for these futures, this is long, delta is 1, so therefore +1 into, you have 10 contracts, 10 into what is your delta? 1. You get 10 TM. Short 3 calls, short, so therefore -1. Number of contracts, number of contracts 3. What is delta? 0.3. What is your net delta on this position? -0.9. Long 4 put up. Long 4 puts. Long, that means +1. Don't worry whether it's put or a call, it's plus. How many contracts? 4. What is delta? -6.5. What is the answer you get? .26. This is the net delta of this position. Short 5 puts, again -1, 5 into -0.9. 0.15 minus minus plus, so the net delta would be 0.75. Net delta of this is equal to 0 because delta is 0. Whatever multiplied by 0, you get ultimately 0. So now what do you have to do? Add these figures together. 10 minus 0.9 plus 0.16 plus 0.75, whatever figure, that is the delta of your portfolio. I think the answer is 10.11. Is it correct?
So here this loan for puts in the sense, is it minus or plus 1?
When it long, the directional bias is plus. When it longs, directional bias is plus, but for a put option, delta is negative. So that's why you get minus sign. Whether it's a call or a put, it doesn't matter. If you are long, your directional bias is plus. If you are short, your directional bias is minus. What does it mean? You short 3 calls. That means you have sold 3 call options.
Okay. 3 short calls mean sold.
You have sold
Long.
3 call options. So therefore your net delta is negative. If the underlying price increase, you make a loss because you have sold the option. If you have bought it, yes, you gain. Then it should be plus 0.9. So your delta is 10.11. What does it mean? If the price of the underlying, that means spot price, increased by $1, value of your position portfolio increased by $10.11. If the underlying price increased by $1, value of your option portfolio increased by $10.11. That is reflected in this cumulative delta. So there's another example. You have the following positions in the same underlying asset: short 4 futures, short 3 at the money calls, long 6 deep in the money puts. What is your cumulative delta? Again, short for futures, short minus number of futures 4. For a futures delta is 1. So therefore, short 3, sorry, minus 4. Short 3 minus 1 into 3 at the money calls. What is the delta of at the money call? It is 0.5. So you get minus 1.5. Long, so plus 1, 6 into deep in the money puts. If it is deep in the money, what is the delta? Minus 1. So minus 6 is net delta. What is cumulative is minus 6, minus 4, minus 10, minus 10 into minus 1.5 minus 11.5. What does it reflect? If spot increase by $1, your value of this portfolio decreased by $11.15. So you are betting on the price to decrease. That's what your expectation. This is 1. Long, so therefore plus 1.
So in this calculation, short for futures in the sense minus 1 we take because
it's short.
Short.
For a future, for a futures contract, delta is always plus 1. If you go back here, futures delta is plus 1 because futures price changes 1 to 1. If the underlying price changed by 1 unit, futures price also changed by 1 unit. You can remember from the payoff diagram for futures contract. If the futures price changed by 1 unit, sorry, if the underlying price changed by 1 unit, value of futures will change by 1 unit. So it's 1 to 1. So that's why delta is 1. Since you have sold futures contract, directional bias is minus 1. You have sold futures, so therefore you multiplied by 4. Delta of one position is 1. So altogether delta of 4 short position is minus 4.
4. And short 3 at the money calls in the sense minus 1 in the sense
because you are short.
Yeah, short minus 1 in the sense
this is to reflect that you are short.
Okay.
This one. The directional bias is obtained by taking account for long and short position plus 4 long and minus 4 short.
Okay. Okay.
So
and that is understood. And 3 is the number of positions. 0.5 is the
delta. This equation. Directional bias, number of position, and delta. That is the how to get a delta position.
Okay. Here the at the money call in the sense plus 0.5 delta from that table.
At the money 0.5 because it's called it's plus. If it was a put at the money, it is negative.
Okay. Yes, yes. As per that table, yes.
At the money, call 0.5.
Right.
At the money put, negative 0.5.
Okay. Okay. Short 3, yeah. -1.9 at the money plus short. Similarly, long 6 also the same way. Yeah. Long
Same,
mean
yes. Long
we
mean
buy.
plus
Yes.
1.
Okay.
6
Right.
contracts
6 contract
in the
in
deep
the
in the
money.
money. Deep in the money puts
Yeah.
have minus 1.
Deep in the put minus. Yes. Right. Okay, sir. Right. And this figure 11.5 meaning is
You
the
just add
value
them.
reduction. Yeah. Okay. That is the point. That interpretation is
Interpretation is if the price of the underlying increased by $1, because this is the delta of the your total portfolio. This is the delta of your
okay.
total portfolio. So how do you interpret delta? If the underlying price changed by $1, what is the change in your value? Since this is negative, if the price increase, value decrease.
Okay.
The negative sign gives you that direction.
Decrease. Direction.
Yes.
Yes.
If spot price increase, your value decreases.
Okay.
The figure gives you the quantity, amount, by how much.
Quantity. Yeah.
If
Okay.
if the underlying price of the underlying increase by $1, your value of your total portfolio, that means all these positions, will go down by $11.15.
Okay.
Clear?
Yes. So this do we need to memorize these things in the exam or like?
Yes.
So
That's what I mentioned earlier as well. When you say deep in the money, you should know for a put it's -1, for a call it's +1. At the money, 0.5, plus 0.5 and minus 0.5. So the thing is, for puts, delta is negative. For calls, for calls, delta is positive. That's the basic. For put options, delta
calls.
is
Okay.
this one.
Negative.
For call options, put is positive, 0 to 1. For put options,
Okay.
delta is negative, -1 to 0. So this is when deep at the money, deep in the money, this happens when deep in the money. This happens again when deep in the money. 0 happens when it's out of the money, especially when it's deep out of the money. When at the money, delta is 0.5 here. Here it's negative 0.5. So you should be clear about this.
Yes.
So this cumulative delta, it is very useful to hedge. What do you mean by hedge? Now you can see here, you know that if the price increased by $1, value of your portfolio decreased by 11.15. You want to make it 0. Whether the price increase or decrease, your value to remain same. That is hedging. So to do that, what you have to do, make your cumulative delta is equal to 0. Then it's price insensitive. Whatever the price changes, value won't change. It doesn't mean that you don't have any value. There's a value. That value will not change. Even the price changes. So that is hedging. So we can use it, this cumulative delta concept. To do that, what you have to do, you have to create a portfolio with cumulative delta of 0. We call it a hedge position of delta neutral position. When your portfolio is delta neutral, that means your portfolio is not sensitive to price changes. Change in underlying price, value of your portfolio won't change. It will remain as it is. So what you can do, 11.15. So basically you want to make it, so delta is minus 11.5. You want to make it 0. So that means you need add delta equal to 11.5. What you can do easily, buy 10 futures, then it will give you plus 10. If you buy 10 futures, it will give you plus 10. Still you need another 1.5. What you can do, buy 3 options at 3 call options at the money, because it's at the money call is 0.5. You buy 3, it will give you 1.5. Altogether it will be plus 11.5. Plus 11.5 minus 11.5, add them together, it will be 0. If you want to hedge this, what you have to do, buy 10 futures contracts and buy at the money, buy 3 at the money options, at the money call options. Basically, you cover this portion, short 3 at the money, buy 3 at the money. So this will wiped out. To take care of this 10, simply go for futures, buy futures. So this is another example. Want to hedge a portfolio with delta of 7.25. So what you have to do, create a position, new portfolio or new position with a delta of minus 7.25, because the existing portfolio, the delta is 7.25 plus. If you want to hedge, cumulative delta should be 0. To make this plus 7.25 to 0, you need minus 7.25. So easily you can achieve this minus 7 by selling 7 futures to get the remaining 0.25. Either you buy a put with delta of 0.25 or sell a call with delta of 0.25. Why? If you sell a call, even though the delta is 0.25 positive, since you sell, it will become minus 0.25. In a put, even though it written as delta of 0.25, that's other thing. It will give you like this, say put with a delta of 0.25. But you should know that since this is a put option, the real figure is minus 0.25. in the market you don't see these minus signs. It will say put with delta, or delta, it will say delta is 0.25. So depending on a put or a call, you should be able to identify whether it's minus or positive. So just by doing these two trades, you can create a portfolio with delta minus 7.25. When you combine new position with the existing portfolio, your portfolio will be delta hedge portfolio or a price insensitive portfolio. But remember, this will hedge only against the price risk. Price will change, value of your portfolio won't change. But in options, value of option, that means price premium of options will change due to time, volatility, and for futures, basis risk. All these risks will remain in the portfolio. So therefore, delta hedge will hedge against only the price risk, and delta won't remain at the same level. Delta also of a particular option, delta will change as time passes and price of the underlying changes. Delta is not a constant figure for a particular or for a given option. Even for a given option like duration, when the yield changes, duration changes. So the depending on the price yield relationship, if the coupon changes, coupon rate changes, duration will change. Likewise, even here, delta is not a constant. Delta will change with the time and the price of the underlying. So therefore, if you want to create a delta hedge portfolio, you may have to do a lot of trades very frequently based on the given delta. There's another example. Assume you sold 100 XYZ 1 month 50 calls. So this is the number of positions you sold. That means minus premium is given, delta is given, spot price is given. This is the number of 100, number of contracts, or the number of options. This is strike. Now let's assume price of XYZ moves up to 49. Earlier it was 48. What is your profit or loss? Go back. Delta is 0.45. You sold -1, so net delta -1 into 100 into delta is 0.45. You get -45. So if price increase by $1, if price increase by $1, your value of the portfolio decreased by $45. So that what would happen. So the example, it says price moves to 49. So increased by $1. So therefore, it's a loss and it's $45. But if you profit or loss, if you have bought 45 of XY, is it? If you have bought XYZ 45, what would happen? This pricing with price increase, you make a profit of $45. This is a profit. This is a loss. So this will be cancelled out. Ultimately, you will get 0. If you have bought 45 shares and had this position as well, you have sold XYZ 100 call options. Your position is delta H. No value change for your portfolio. So why do we do this sort of transactions? While you are selling 100 options on a particular company, you buy for 45 shares on the same company. So whatever the price change, value of your portfolio won't change. Why do you do that? Price changes, you won't make any profit or loss. Why do you do that? What is the gain for the trader? The gain for the trader is when he sells these options, what he get when he sell options, he'll collect premium. He'll collect premium, but on the maturity date, he does not face any risk because of this delta hedge position. Whatever the market price, value of his portfolio won't change. So he can collect the premiums without taking any risk. That's why without taking any market risk, there may be other risk as I mentioned earlier, basis risk or the time decay factor, volatility, those will be there. But basically, price risk is hedge. So other Greeks, first one is gamma. Gamma is the change in delta, like convexity. Gamma measures how delta changes with the price of the underlying changes. So how much the delta of an option changes when the price of the underlying moves by 1. So for example, in this delta is 0.45. The price is 48. When the price moves from 48 to 49, what would be the change in this delta? It may not remain as 0.45. It will change. It will increase because it's moving towards the strike at the money level. So this delta should go close to 0.5. That is measured through gamma. What is the change in delta for a change in 1 unit of price? Gamma is very small when the option is either deep in the money or far out of the money. In the two extremes, gamma is very small. That means delta won't change for a given price change. Yes. Is there any question?
That previous example, the slide number 69.
This one?
This, yes, yes.
Yes.
What is your profit? What is your profit or loss? That is $55.
45.
Oh, sorry, $45.
It's a loss.
It's a loss of $45. Okay.
Yes.
And what is your profit of loss if you have brought 55 shares?
Yes. If you have bought 45 shares Now the price is 48. When the price goes to 49, per share you earn $1. So $45, you make a profit of $45. For 45 shares, $1 per share, you make a profit of
Okay.
$45. But once you combine this 45 shares with these options, that means you have 100 short calls and long 45 shares. At the end, when the price moves by $1, your profit is 0. In the aggregate portfolio, share portfolio and the option portfolio, when you put them together, your profit is 0.
0.
Because you lose
Okay.
45 here, you gain 45 here.
Okay.
That is called delta hedging. So in the two extremes, whether it's a call option or a put option, when the options are deep in the money or deep out of the money, gamma, that means change in the delta, is very small. But when it closer to at the money, this gamma changes by delta changes by large amounts, therefore gamma is high. Especially when the option is at the money and close to expiry. At that time, that's the time where the option is very sensitive for the changes in underlying price. So you just remember these facts: what is gamma and how gamma changes with the in the money and out of the money and at the money options. So since gamma is the measure of the changes in delta, as we did the convexity adjustment, we can use this gamma as to do a adjustment in the changes in value of the portfolio. So consider this example: 100 XYZ 1 month calls. Gamma is 0.07. What is the delta after the price of XYZ moves to 49? The previous example, same thing. At when the price is 48, delta was 0.45. Now it says gamma is 0.07. That means when 48 goes to 49, delta change by 0.07. What is new delta? It should be 0.52. Because for a 1 unit of price change, delta changes by 0.07. Current delta is 0.45. With new delta, with this gamma, it moves to 0.52. What is the profit or loss if price moves to 50 and you had to purchase the same number of stocks, that is 45? Again, now you know what is the current delta. You can do the calculation. If the price moves to 50 from 48, or no, assume 48 to 49, then 49 to 50, what is the price change? Do the calculation like we did here. Then it will be a loss of 52 because the delta is 52 now. It will be a loss of $52. But since if you had bought only 45 stocks, it will give you a profit of only 45 when it's moving from 49 to 50. It will give you only $45, but your loss is 52. So this is not enough. So therefore, when price moves from 48 to 49, at this point you have to buy. At this point, if you had 45 stocks, when price moves from 45 to 49, your total profit including the position is 0, because it gives a minus 45 and plus 45. But if you keep this plus 45, when price moves from 49 to 50, your loss would be 52 on the options and 45 on the underlying asset. Still you make a loss of minus 7. How do you stop that? That is the required delta adjustment. That means now when price moves to 49, what do you have to do? You have to buy another 7 shares and make it 52 shares. Then the price moves from 49 to 50. Option will give you a loss of 52. These shares will give you a gain of 52. Again, that will be set off each other and overall profit would be 0. This mechanism is called delta hedging. With the price change, delta changes, you keep buying or selling underlying asset according to delta to make your portfolio delta hedge or market neutral portfolio. That is the method that we call delta hedging, where you create a market neutral portfolio. Then the next Greek is Vega. This measures the sensitivity of sensitivity of premium for the volatility. If a volatility changed by 1%, what is the change in option price? As if you can remember, volatility is always positively related to the premium. Whether it's call or a put, it doesn't matter. When volatility increases, premium increases. When volatility decreases, premium decreases. So therefore, this sensitivity Vega is always positive for long positions in both call and put. Positive only for long positions. It would become negative if it is short position. And again, at the money options are very sensitive. So even for the volatility, at the money options are very sensitive. So therefore, Vega is high for at the money options, and it is high for long dates options as well. So it is this effect by the expected volatility. What do you expect? What is the volatility that you expect in the future, not today? Because based on today volatility, the option is price. What you have to worry about, what would be the volatility in future, because that will change the price of the option. So again, Vega can be used to measure sensitivity of a one option, one position, or again a collection of options. That is option portfolio, sensitive to both market sentiment and current market conditions in terms of volatility. And so based on this, wherever we have a variable, we can trade that variable. So traders can do trades based on the volatility with that new delta neutral portfolio. They create a delta neutral portfolio. What does it mean? Value of the portfolio won't change if the market price of the underlying asset changes. That is delta neutral portfolio. But as I mentioned, value of options can change for other variables, changes in other variables. One is Vega. If volatility changes, value of options changes. But that portfolio is immunized for the market price changes. So the traders, they won't take the risk of market price, but the volatility. They know if the volatility increase, option premium increases. So based on their expectation, they create portfolios. If the trader expects volatility to increase in the future, they will buy options. When you buy the option, volatility increase, value of options premium increases. So you make a profit. If you expect volatility to decrease, they create a portfolio, maybe sell options. Then when volatility decreases, value of the portfolio increases. So that is called volatility trading or vol trading. Theta is the other measure. So not in delta and gamma, but in Vega, we can remember it as volatility. V for volatility. In the next one, theta, T for time. Theta measures the sensitivity of the option price for the change in time, because with the time time to expiry get reduces, as we discussed at the very beginning, that time decay factor is there. That means when the time to expiry reduces, time value of the option decreases. So therefore, any long also puts theta is negative, because when time reduces, value decreases. For short, it's positive. Value of the position increases with time decrease. So how to measure this? We are not going to discuss how to measure this theta or Vega. For that we need that equations, how to price the options based on Black-Scholes models or any other model. So here we are not going to discuss how to derive, but what is the impact. You should be able to assess the impact, at least the directional impact, not the quantitative impact. So the theta is higher when either volatility is lower or there are few days to expiration. If the market is less volatile, then time factor matters. Or if the option is about to expire, very close, then theta is high, because if you can remember, curve is like this. Near the expiry, value goes down by drastically. For a 1 day, price drop is high, closer to maturity, so that sensitivity theta is high. The rho is R, interest rate. Rho measures the sensitivity of the option price to the interest rate change. Exactly speaking, for a 1% change in interest rate, what would be the price change in the options? So this impact is based on the cost of carry. For physical underlying, this will have an impact. If you are to buy the underlying and keep it, what would be the cost of carrying that position? Depending on that, as I mentioned earlier, value of the option changes. As I mentioned in the morning, increase interest rate will increase the value of calls but decrease the value of puts because of this cost of carry concept. Premium payment, this is something that we discussed. For options traded in exchanges, depending on the contract and things, you may have to keep margins. However, we are not going to discuss about margins, so forget about this one. But remember, as a buyer, you have to pay the premium immediately to the seller of the option. So that this is something that we discussed earlier. So that's all for today what we want to discuss. If you have any questions, but to summarize, first we will started with premium. What are the determinants of premium? And classification of options in the money and out of the money. Then we discuss time value and intrinsic value of option, how this time factor impacts on the premium, how this the difference between underlying asset price and the strike price, the difference between these two, how would that affect the premium? Then volatility, interest rate, how those factors will affect the premium. We discussed that. Then we discuss the put call parity, then how to identify whether there is any arbitrage opportunity, how to explore that arbitrage, if there's any arbitrage, what are the trades to be carried out. Then the Greeks, that means sensitivities, option sensitivities, we call option Greeks: delta, gamma, theta, vega, rho, all these things. Delta is the price sensitivity of options for a change in price in the underlying asset. Gamma is the change in delta for a change in underlying price of the underlying asset. Then vega is the change in option premium for a change in volatility. Theta is the change in premium for a change in time to expiry. Rho is the sensitivity of the option premiums for a change in interest rates. And we discuss all those relationships as well. So that's all. If you have any questions, you can ask any questions. Next week we'll start with FRA, forward rate agreements, and let's see whether we can move into interest rate swaps and other products. But we'll start with forward rate agreements next week. So if you don't have any questions, we can wind up here and see you next week.